We start. Welcome all of you. Welcome everybody to this launch event of the new edition of the Global Tax Expenditures Transparency Index, the GTETI, and also the 2025 Flagship Report of our Tax Expenditures Lab. Very happy to have you here with us, and we're grateful that you take the time, and we look forward to a very interesting event over the next 2.5 hours. I would like to particularly welcome the authors and co-authors of our flagship report chapters who also are going to be panelists in the following sessions. And let me just say again that we are really grateful for the excellent contributions that you made to our report, and also for driving the tax expenditure agenda forward together with us. I think that this is very important. We're very happy about that. So this is the third edition of the flagship report, which comes out every second year. So we started in 21, 23 was the second one, and this year is the third in a row. We will put the link to the flagship report in the chat, so it's public as of this moment. You can download it from our Tax Expenditure Lab website, and we hope that you will do that. We invite you to do that, and we hope that you find it an interesting and inspiring read. This year, a main focus has been put on tax expenditure effectiveness, which obviously is a core issue when you think about not only about evaluation and reform of tax expenditures, but also actually starting with the design and the operation, the implementation of tax expenditures. Effectiveness is such an important issue. So in the flagship report, in the different chapters, we discuss what makes tax expenditures effective, looking at the available evidence, partly also from our global tax expenditures database, the GTED. But we also look at administrative and data requirements for effective tax expenditures. And then there are several chapters that provide deep dives into particular aspects, such as VAT-related tax expenditures, climate change-related tax incentives, and also tax incentives to promote research and development, R&D. Now, with regard to the global tax expenditures transparency, we are very happy to share the new edition with you today, the GTETI, as we call it. It's the first comparative assessment of tax expenditure reporting, covering countries worldwide. It was first launched in 2023 when we had 105 countries in the index. Now today we have 116, same as the GTED. And we are using information published by governments before December 31st, 2024. So roughly 1 year ago. The link is also already in the chat. Thank you, Peppa. And as my colleagues Lucas Millan and Paula Castells from CEP will explain to you in more detail, the GTETI scores and ranks countries according to the quality of reporting. So it's not scoring and ranking countries according to the quality of tax expenditure use, and also not scoring and ranking countries according to the amount of revenue forgone linked to the use of tax expenditures. But Lucas and Paula will discuss this, or will run you through the GTETI and the main messages in a minute. Before, let me just quickly point you to some issues of housekeeping. So as we have already announced in the chat, and I think when you have entered the session, you were informed about that as well, we are going to record the session, the event, and we are planning to put it on our YouTube channel. We got the consent from the presenters for this, and with all the other participants, if you do not wish to appear in person, but do wish to actively participate in the questions and answers session, the Q&A sessions and comments, you can still do that by using the chat function or the Q&A function. It's enabled, and you can always leave your questions and comments there. and it will be addressed either in written form directly by someone from the team, or we will raise those issues in the discussions if time permits. So just a quick run through the agenda of today's event. We are going to start with the presentation of the new edition of the GTETI, the Global Tax Expenditures Transparency Index, followed directly by a first round of Q&A. And then we will have a first panel based on the flagship report chapters on the state of tax expenditure reporting, on data aspects, on administrative aspects of tax expenditure effectiveness. Then there will be a second panel where we present key messages on the available evidence on tax expenditure effectiveness, then the targeting of VAT-related tax expenditures, the application of climate-related tax incentives, and finally, the issue of tax incentives implemented to promote R&D. And both panels, as said, will provide opportunities for you to come in with questions and comments. And afterwards, my colleague Agustin Redonda from CEP will close the event. And with this, thank you. And I hand over to Lucas and Paula for their presentation of the GTETI.
Thank you, Christian.
Good.
Lurin, could you share the screen, please?
I'll share it instead. Sorry. That's it. Does it work well?
Yep. Super. So good morning, good afternoon, everyone. And thank you for joining us today. My name is Paula Castells Carrion. I'm a consultant with SEP and part of the team behind the Global Tax Expenditure Transparency Index. Sorry, it's a mouthful, or GTETI. Together with Lucas, we're going to walk you through the key insights from the GTETI version 2.0. You can go to the next one, Lucas. Still. So the GTETI gives us a structured way to compare how countries report on their tax expenditures, looking at how regularly they publish reports, how good those reports are, and how much information they include. As Christian mentioned, this is the second edition of the index, covering reports published up to December 2024. Beyond global and regional trends, the GTETI also offers very detailed country-specific information on how each government reports on tax expenditures. And how we do that is by assessing each country across 5 dimensions, which you can see right now on the screen, 25 indicators, and 140 supporting data points, all which are backed by comments and sources. The 5 dimensions that we assess are the public availability, the institutional framework, the methodology and scope, the descriptive T data, and the T assessment. Each of them captures one essential aspect of transparency. When we look into the main findings, we will share a more detailed description of each of these dimensions. So now I'm just gonna quickly go through it. You can go to the next one. Another way to understand the GTETI is to see how it fits into the entire expenditure policy cycle, from identifying provisions and publishing reports to integrating them into the budget process and eventually assessing whether these measures actually work. So in the next visual, it really helps to highlight that transparency isn't just about producing a report, but instead it's a core element of the broader fiscal governance. I just wanted to give you like this quick preview on this matter because the panels later on will go much deeper into the topic. You can go to the next one. Regarding the research process itself, every jurisdiction is assessed through a multi-stage process with six stages, which you can now see in the screen, that include data collection, internal review, and government feedback. We start by having the reports identified, then we have a researcher going into the assessment. And the structure that we have proposed with all these levels really helps to reduce the human error and tries to ensures that countries are evaluated as objectively as possible. So maybe I just go through the key insights into the process instead of just telling you each of the stages, which you can clearly see in the screen, is that in this new version of the GTETI, we have included an audit stage, which is stage 3, in which one researcher conducts the assessment and a second researcher audits it, resolving inconsistencies with automatic verification tools. Then we go into the stage 4, that is the troubleshooting. We go into formal reviews, and also that allows us to also consider any inconsistencies before sharing in stage 5 governments for their feedback.
Paula, just a quick intervention here. There was the question if you could speak a little bit slower. You are good in time, so we are good in time. You can take your time and speak a bit slower, please.
I'm sorry. Yeah, of course. Thank you, Christian. And I'm sorry if I'm speeding up. I just was very aware of the time. So, of course. So I just go again through the stage process. The research process is composed by 6 stages. The first stage is to identify the TE report. Then we have stage 2, which is an assessment done by a first researcher. Stage 3 is including an audit process. The audit process takes the assessment made by the first researcher in stage 2, and then it checks into any inconsistencies that could be appearing, and resolving it with automated verification tools that we have embedded in the questionnaires. After that, we have a stage 4 troubleshooting, and we check any other kind of inconsistencies that could be appearing before we share the questionnaires to government, which is a stage 5. And the final stage is a horizontal review that allows to revise score changes and to incorporate any relevant feedback that governments have shared with us. In stage 6, we also, now that we have the second edition, we also check scoring differences with the previous edition, confirming that shifts in the scores reflect like real changes in the report practices or the methodology. So after we follow all of these steps, we arrive to the final data set and the final scores. You can go to the next one, Lucas. This is just a summary of the main changes that I just mentioned. So the in-depth research of the official reports is one of the main changes that we have incorporated in stage 1. The audit assessment is one of the main changes that we have incorporated in stage 3. Before that, we used to do a parallel review that required 2 researchers doing the assessment at the same time, and then we have to reconcile the data. So the audit is replacing that process. And one of the other changes that we have incorporated is regarding the stage 6 in the horizontal and cross edition review, taking advantage of the fact that we have now a second edition also available. So we cross-check the scores and try to check on these shifts that could be reflected. Super. Other changes that I'd like to share with you is in terms of the reporting countries and also a few methodological changes that we have incorporated. So the number of countries with at least one tax expenditure report increased by 11. So now as Chris mentioned, we have 116 countries that we are assessing through the GTETI. We also saw a strong engagement. There's 17, well, strong depending on what you compare to, but 17 governments provided direct feedback on their assessment. And regarding the methodological changes, there are a few of them. In dimension 1, now the report requires to have a explicit date, otherwise the score is downgraded. We strengthened the criteria for identifying structural tax provisions and improved checks of completeness in dimension 3. In dimension 4, we are fully aligning with the GTED data, and we also excluded negative values of the listing of the provisions. And in dimension 5, we now distinguish more clearly between impact evaluations and incidence analysis, and we are updating the scoring scale. So some of the changes in the score are directly influenced by these methodological modifications. So we wanted to also be transparent in which methodological things we have changed. Super. Now we want to look a bit into the average scores and the main results we have obtained in this GTETI assessment. Looking at the average scores, now you can see in the screen we have the 5 dimensions, and in the column in the left we have the scores, and in the column on the right you can see the variation of that score in terms also of the GTETI 2022 or the last edition. So the the minus 0.3 that you can see next to the 11.1 in public availability shows that there is a decrease on the score of 0.3 points. Some things that are important to mention are that each dimension is a score out of 20 points based on 5 indicators that each are a score out of 4 points. All the dimensions and indicators are equally weighted. So that's also very important to understand a bit more of the methodology. The average score of the reporting countries is now 46.9 out of 100. And this is a modest improvement from the 45.5 score in the previous edition. But this small change hides some substantial progress in several individual countries. So we are very happy to see the score being increased. If we also include the non-reporting countries, the global average falls to 24.96. What do I mean by non-reporting countries? So there are 218 jurisdictions. Of those 218 jurisdictions, we only evaluate the 116 that actually have a TRI report to publish. So if we include the non-reporting countries, definitely the score is lower by a lot. But this 24.96 still is an increase of more than 2.5 points since last edition, which is mainly driven by the higher number of reporting countries that we have now included. Even with these improvements, scores, as you can see, in each of the dimensions and each of the tables are remaining quite low if we consider that each of them is a score over 20 points. So 3 dimensions now, scores, methodology and scope, descriptive data, and TA assessment, as you can see, all remain below the median with 8.9, 9 points, and 6.4. The highest average score is in dimension 2 in the institutional framework with a score of 11.5 out of 20, which also is a slight improvement since last edition by over 1 point. However, this score is also pulled down because very few countries mention tax expenditures in their budget proposals or in the medium-term fiscal strategies, which is one of the aspects that we analyze in this dimension. And even fewer of them discuss policy goals or other core elements. So you can see that in indicators 2.4 and 2.5 in the budget integration and in the medium-term fiscal strategy, which are the lowest in this dimension with 1.3 points and 1.6 points. On the other end, if you see dimension 5, which is the T assessment, it only scores 6.4 points out of 20, which remains the lowest scoring dimension, also in regards of last edition. So this is concerning because this dimension captures not only how revenue foregone estimates are presented, but also what governments do in terms of evaluating their tax expenditures. With very few exceptions, Lucas is going to go a bit deeper into this later on. T evaluations are not included nor referenced in the reports. So you can see that in indicators 5.4 and 5.5 in the table. And the other aspect that downgrades the score is that very few countries share forward-looking projections in the report. So that's in indicator 5.3. However, the other dimensions also face important challenges, even if their scores are a bit higher than dimension 5. If you go to the public availability table now, and you see indicator 1.3 in visibility, the availability is affected because only a small number of countries publish a press release announcing the report. And if we go into the online accessibility, which is also one of the lowest scores in this dimension, very few countries publish underlying data files. So that limits transparency if you have to extract manually the information from a report, if they provide that information. Going into dimension 3, the methodology and scope, the scores are affected mostly because very few jurisdictions clearly disclose tax benchmark at the T provision level, which is captured in indicator 3.2. If you can see that, in the table. It's just 1.6 points out of 4. Many countries still do not provide enough information to distinguish structural provisions from tax expenditures, which is captured by indicator 3.3. So you can see that the score is only 1 out of 4. Going to dimension 4, the descriptive T data, many countries still fail to systematically include basic elements such as target groups and time frameworks attached to the TE provisions, which is reflected by indicators 4.3 and 4.4, which takes the overall score of this dimension down. So I wanted to just highlight the overall view of the scoring before Lucas goes into the more detailed highlights of each of the dimensions, and to give you a quick view of the overall scores that we have obtained in this version of the GTED, in this edition. So to you, Lucas, and I'm sorry again for speeding up at the beginning.
Thank you, Paula. And I will continue with the best practices and highlights by dimension, presenting the top 10 best performers by dimension and sharing like a couple of interesting insights. So in a dimension one, public availability, what we find is that about 53% of countries report regularly. 60% have an online repository showing all historic T reports, but only 17% publish the underlying data file. In terms of best practices, we see here the numerical top 10, but a few cases are worth mentioning. For example, Zambia and Ecuador, which publish dedicated press releases about the T report. Brazil, for example, that publishes a very detailed uh, accompanying a data file, and Australia, which just in the last issue of the T report has included a downloadable data file. It previously did not. And finally, 5 countries that present a version of the T report, which is um, accessible for visually impaired individuals, which means that, for example, it's available in HTML format, which with adjustable fonts. It presents colors and a clear structure. So we have the best case would be Netherlands, but also Canada, the United Kingdom, Croatia, and Norway present such versions. Um, in dimension two, with regards to the institutional framework, overall, we find that 69% of countries have a legal requirement to periodically report on tax expenditures, yet almost half of those countries, when cross-checked with the indicator 1.1 on frequency of T reporting, we see that almost half of these countries report irregularly. Uh, on average, also, we find that countries that do have such legal obligation to report score 26% higher. And with regards to the integration of tax expenditures policies in the medium-term fiscal frameworks, 64% of countries mention tax expenditures in such documents, and a lower 15% does provide more detailed guidelines on the future directions of the policy making, such as stating, for example, policy objectives over the medium term, or expectations in terms of the size of revenue foregone, if it's expected to grow or to decrease in specific or general ways. In this sense, also, we find that 48 countries present a specific legal obligations, not only to report on ETs, but also clarify in the law who is responsible for reporting, and that the report should be submitted to the parliament. In the case of medium-term frameworks, we see best practices in countries such as Ecuador, Ethiopia, or Italy. In dimension three, which is, I would say, one of the most important, uh, uh, we see that only 15% of countries claim a full coverage of existing Ts, which means that not only they present information for all the types of taxes that are available nationally, but also that present a stated full inventory of available tax expenditures, regardless of whether revenue foregone estimates are provided. In that sense, for example, Indonesia, Guinea, and Burkina Faso clearly state that and provide detailed information, including for non-costed tax expenditures. With regards to the tax benchmark, if 50% of countries describe the benchmark by type of tax is the most common way of describing the reference tax system that serves as basis to calculate tax expenditures, and 11% of countries, including Indonesia, Moldova, Mexico, provide this information by T provision, which means that for every preferential tax provision, we know what would happen otherwise. So if the T provision wasn't enforced, which is very useful not only for a calculation, but for verification purposes. We find, however, that almost 50% of countries do not state the necessary economic assumptions with regards to the calculation of revenue foregone. So for backward estimates, the most classic assumption is that the behavior of taxpayers is not taken into account. So if in the past we had removed tax expenditures that taxpayers wouldn't, for example, have decided not to expand a business or not to purchase certain things. And with regards to forward estimates, we do have to know what future state of the economy we're talking about. And in that case, we find best practices, sorry, yeah, in Burkina Faso and Brazil, but also for countries that provide revenue foregone forecasts like Uganda, that will provide different scenarios depending on these assumptions.
Lucas, you have 3 minutes.
3 minutes. Okay, so most countries include policy objectives. Only 18% include information on the number of beneficiaries, which is what makes indicator 4.3 particularly low, and 38% do not include any specific legal reference for applicability provisions. However, Benin, Ireland, and Greece do provide the number of beneficiaries for over 80% of T provisions. With regards to tax expenditure assessment, that is the assessment of revenue foregone, we see that about 25% of countries only provide aggregate estimates. 22%, however, provide 5 or more years of backward revenue foregone estimates. With regards to revenue foregone forecasts, the best practices are found in the US, for example, with more than 10 years of forecasts, and Benin with 5 or more years. More worryingly, I would say 84% of countries do not include or reference any T evaluation, but 9% include impact assessments, that is an analysis of the one or more impact related variables, that is variables that have to do with the policy objective of the tax expenditure. Quickly to the GTETI ranking. So we see here in the top 20 mostly high income countries, but a couple of countries like Benin or even Guinea that enters the top trend, the top 20, and a few upper middle income countries, among which Indonesia number two, again Ecuador and Brazil. In the top 25, we can also find Mauritania, Niger, and Pakistan. At the other end of the index, we see mostly upper middle income countries, 9 out of the 20 shown here, and 4 high income countries, Poland, Hungary, Panama, and the Cayman Islands, which recently entered the index, and a bit above, but still among the lowest scoring countries, we find India, Japan, Switzerland, and Turkey. This is a quick overview of how like the top 20 changes. And now it can seem like a bit confusing, but the bottom line is that most countries that were in the top 20 stay in the top 20, with a couple of differences, notably the United States and Austria, which haven't decreased their score. Actually, I think that both of them slightly increased them, but other countries improved above them, notably Greece, Chile, and Guinea that enter the top 20. So again, a couple of points. This index allows to check regional best practices and enforce peer learning. Any person can check for their country and nearby countries how they do and see what they can learn from their neighbors. For econometric purposes, I would say it's an essential gateway for comparability assessments, in the sense that if you do not know how certain revenue foregone estimates are calculated, information which is available in dimension 3 of the index, you cannot properly compare revenue foregone amounts or integrate them in econometric analysis. Of course, all of this, and especially the low scores in dimension 5, speak about the complexity and problems of administrative capacity, given the high number of the provisions and the low amount of revenue foregone that is actually evaluated. And yeah, just to say that more insights are available in the website. Thank you.
Thank you so much, Lucas. Thanks also for keeping the time. This gives us some time for comments or questions. If you want to raise a question, you can either put it in the Q&A or you can raise your hand. And there was one question which goes to the very core of index building, I would say. That's the question about why do we give all indicators and all dimensions the same weight in the index? This is a question that we have discussed internally quite a lot. And I would ask Lucas perhaps to start. I guess colleagues from CEP will also be happy to join in case additional points have to be made. And as I said, you are encouraged to either put your questions in the Q&A or raise your hand. I don't know, Andy Colby, you raised your hand for some time and you lowered it again, so I'm not sure if you're going to ask something. But let's start with the question by Gail about the weight.
So in the process of building this index, beyond trying to be exhaustive about all of the issues that we wanted to cover in the index, we also ran a survey among not only those involved in the construction of the building of the index internally, but also with external experts in various international organizations and experts that had been involved building other indexes. And so like this allowed kind of like a first level mapping of the relative importance of the measured items, let's say, and then on that basis, the contents of the indicators were designed. So what you can see in the index is, for example, that several indicators relate to revenue foregone. We have indicator 5.1, 5.2, 5.3. We have two indicators that relate to the evaluation, and so on. For example, like the legal basis also has three indicators. So this allows to kind of like to map out like the relative i- importance of different topics. But let's say that like indexes are also importantly communication tools, and what all experts told us consistently is that the hardship in explaining different weights it's is much more problematic than to simply have equal weights across indicators, to say like, hey, like overall we find that all of these measured items have the same importance, even if, as I mentioned, some topics can be covered by more than one indicator.
Right. Yes, thank you. I think you really made the point, in particular, because obviously for us, there are some dimensions that we think are absolutely core, like, for instance, the existence of sound estimation of revenue forgone from tax expenditures. And as Lucas has said, we had discussed internally, but also with external experts in several workshops, to which degree this could and should be reflected in our weighting exercise across dimensions and indicators. And the issue is that if you introduce weighting, you introduce an additional level of discretion, which does not add value to the index, but rather takes value from the index. So that's why we decided to keep it in an equal weight. Balint has a question. What is the past or expected process and timeline of replying to government feedback about the scoring and incorporating it into the published scores? Another highly relevant question. Thank you. Who wants to address this? Lucas, I guess you or Paula?
Yeah, sorry. For the types of feedbacks for which we had, let's say, doubts or contrary positions, we have followed up already. However, for the other countries, we simply implemented this feedback in our evaluations and integrated it in the final data set. We will follow up specifically with each country with regards to methodological doubts, but we expect that every single indicator is clearly explained at the level of comments.
Chris, can I add something on that?
Yes, please do.
Yeah, because I think this is important. As we're very open and actually willing to get feedback from governments. This is an important part in our assessment process. As Paula mentioned, we don't get always feedback. We understand our colleagues in the Ministry of Finance are busy, so we don't expect all of them to go through the full assessment. But when they do, we really take this into consideration carefully. And the feedback we get goes from there is a new T report that has been published after the cutoff date, and then we need to come back saying, okay, thanks, this will be considered for the next round, to super detailed questions about the method, where it can go from, okay, we missed something, but it can also be we don't agree with your take on this indicator. So it really covers a full range of different comments and questions and feedback. In any case, we really appreciate that, and we take the time to answer, as Lucas said, either before or after the launch of the GTETI. We apologize for that, but we will if we have not yet. But this is important. I just want to, because I know that there are some colleagues from Ministries of Finance and Governments here. We really appreciate them taking the time, and we, for us, it's a key piece of information in a sense, right? So when you do have the time, please keep doing it. We appreciate that.
Thank you, Agustin. And another super interesting question from Deepak Sharma, I think, shows that the audience is really very knowledgeable about tax expenditures. Is there an indicator that looks at independent estimates of tax expenditures in countries and therefore evaluates the quality of government reporting against independent estimates? Who would like to address this question?
I can shortly say that No, I mean we only take into account, I think, both in the GTED and in the index official estimates of revenue foregone. So that has always been the aim to kind of like gather and evaluate the availability of official estimates. Florian?
And to add to that, I would probably say that it's important to mention that it would be very difficult for non-government entities to estimate tax expenditure because the data needed is typically administrative data that others often do not have access. And actually, it's often even the case that the Ministry of Finance itself has struggles getting data from the tax administration to do this. But yeah.
Yeah, thank you. Damien Cubisol from CERDI, from Clermont-Ferrand in France, project partner of us, has asked if the data set includes subnational tax expenditure reports. And this is something that is also quite relevant in several federal countries. Like Canada, for instance, also my home country, Germany, has subnational tax expenditures. But we see that the quality of tax expenditure reporting, even in those countries that have above the average national tax expenditure reporting, is so diverse that it's almost impossible with the resources that we have at our disposal to put together this data and put it in the data set. It's something that we would like to do, certainly, because we see, as I said, that in some countries, subnational tax expenditures are clearly relevant, but that goes beyond the scope of our tax of our database and also for the transparency index. Are there any other questions or comments from participants? I don't see any at this moment, so I would hand over to Sophia Berg from CEP to moderate the first panel. Sophia, over to you.
Yes, thank you, Chris. So I will kick off the first panel, which is about more general conditions and the context surrounding tax expenditures. And we have a great set of panelists for this session. First, we have my colleague Flurim Aliou from Council on Economic Policies, who will talk more broadly about tax expenditure reporting, setting the scene. Then we have Maria Juste from UNU Wider, who will give us some insight about data and how important that is with regards to tax expenditures and tax expenditures efficiency. And lastly, we also have Miguel Pecho from the IMF, who will share details and administrative aspects surrounding tax incentives. So first, Florim, questions to you. I have one question that is a combined set of three questions. First, so since the launch of the last flagship report in 2023, how has the use of tax expenditures developed since then? And what are the good news, if any, and potential negative or more challenging issues?
All right. Thank you, Sophia. So I'll start with good news first. And I know that you asked about use, and I will get to that. But I want to start on the transparency aspect first, because we really see clear progress there. More countries are reporting on tax expenditures than ever before. The GTED now includes 116 jurisdictions, up from 105 in the last edition of the flagship report, and crucially up from 97 since the launch of the GTED in 2021. So we see that this increased transparency has been worldwide. So we have new reporting countries from each region of the world, which is a very good sign. And for the first time, more than half of the world's jurisdictions publish tax expenditure reports. And if we look at this distribution in terms of GDP or global population, the picture is even more positive. Countries that do report on tax expenditures account for about 3/4 of the world's GDP, 75%, and 70% of the world's population. So really positive picture here. And not only are more countries reporting, the quality of reporting is also improving, which means that the GTED is also improving as a source of information. Now, as you will see if you read chapter 2, more countries include information on policy objectives, on legal references, on start and end dates of their provisions, on targeted beneficiaries, and so on. And this is again true across the world. We have countries like Luxembourg and Ireland publishing better reports, alongside countries like the Maldives, Mauritania, or Tunisia, who all improve their reporting across editions. And these are just a few of the examples. We have quite a few more. And then other positive news is that the GTED itself is being used more and more from publications and international organizations like the IMF or the World Bank or the United Nations, also in regional organizations like the Inter-American Development Bank or the Asian Development Bank. But for us, at least, very importantly, also in the national tax expenditure reports of countries, as well as academia and the media. So I would really like to thank all of you who have used the GTED in the past and continue to use it now. It really keeps us motivated to work on this public good. And maybe since I'm saying thanks, I would maybe say an even bigger thanks to our research assistants, Daniela, Paula, and Abigail, who continue to do a great job keeping the GTED up to date. But now, since you asked me about the evolution of use, I will say that the news there are not necessarily good or bad. The use of tax expenditures has remained quite stable, which maybe is bad news in some cases, and I can mention that a bit later. But overall, countries still forego about 4% of their GDP and about 1/4% of their tax revenue on average. This hasn't changed much despite the inclusion of almost 20 new countries and better data for many countries since the GTED launch. There are still big differences in what purposes tax expenditures serve across regions and across income groups. To give you a few examples, in low-income countries, tax expenditures are often enacted as tools for general investment promotion. There are many tax holidays that are reported that remain in place or even newly introduced. And maybe this is the part with the bad news. Despite a lot of research suggesting that this isn't necessarily the best way to go, this continues to persist as a practice. In middle-income countries, tax expenditures are typically a bit more targeted, and they serve specific strategic sectors. Although, again, tax holidays are quite prevalent, especially in lower middle-income countries. And then in high-income countries, tax expenditures often serve more welfare purposes. So we see a lot of provisions such as childcare deductions or pension-related tax expenditures, and these are much more prevalent here. And I guess at this point, it's probably good to remind everyone that the GTED shows what the countries are trying to do with their tax expenditures in its policy objective field. It doesn't say anything about whether they're actually achieving what the objectives are they set out to achieve. So even if some of those objectives sound very nice, they may not necessarily materialize. And to actually understand this better, each country needs to carry out evaluations of their policies. But unfortunately, as we saw from the GTETI, most countries do not do this, so that there goes a little bit more of the bad news. But in general, I think the picture is really positive and improving.
Yes, thank you, Florim. And also a reminder to the attendees of this webinar, please post any questions in the Q&A or save them for a few minutes after, where we will have a Q&A session where you can engage as well. Just a reminder. But Maria, as Fleur mentioned in his previous intervention, data is crucial for tax expenditure reporting and data quality even more so. UniWider is engaged in creating and collaborating on several data labs across Africa. So you would be more than well equipped to answer the question about data management and access to data and how important this is with regards to tax expenditure effectiveness.
Thank you, Sophia. Yes, as Florin said already, that the data is really missing in many places and many countries, and it's really crucial on this analyzing the effectiveness and evaluation of the tax expenditure policies. And as we know, the tax expenditure policies are the major fiscal policy tool, as Florin just said, it's widely used, and we know many times too little about it, how it meets its objectives. And especially the data is a limitation part there. So the data in general, the access on it, the quality of it, and also the integration of it with different institutions. So basically, without reliable data, governments cannot know the true cost of the tax expenditures or whether they achieve the intended objectives, as Florin said. And in that way, data is not just a technical detail, it's more like a cornerstone of the whole credible tax expenditure policy evaluation and effectiveness. And as you said, we have worked on the area of how to improve the access to the data in few countries. But basically, the aim is that the access to the reliable data enables these governments to estimate revenue foregone and understand behavioral, but also welfare impacts, so those objectives of the tax expenditure policies. And in many countries, especially in developing ones, where we work very closely as UNI-wide, the data gaps are even higher than in developed countries. And it's really hard to design these tax expenditure policies without knowing how they are working. And in that way, when you design them and you don't really have a data, you don't know much about it, it can lead to the unintended consequences, inefficiency and inequity in the tax system. And in that way, the public access to the data or public access to the reporting is super important. And also we try to, as UNI-wide, for example, to create these administrative data labs to allow the access to the data for researchers, but also it could help on the Ministry of Finances and other institutions in the country. And what we do in that regard is also not only focus on how to access the data, it's also how to improve the quality of the data. So when the people are starting using the data, the quality is usually more scrutinized. And for example, revenue auditors start to know how to collect the data better to answer these questions. And also in that regard, it's not only tax data or administrative data, it's also other data sources which could be combined with different data sets, like the household survey data could look at the consumption, distributional impacts, sectoral data from different ministries, like education data. You could evaluate specific sector-specific policies. And these play an integral role on the evaluation effectiveness. And in that regard, the data management come in play in role, because the data integration from different sources is really hard without documenting well how to collect the data, what is in the data, how to use the data. So data management in general is really important part of the getting the access to the data and also integrated between the different government institutions. But in that way, it also could help on the better data management, and better public documentation can help to improve the transparency, sustainability, accountability of the both the reporting, but also the data itself. And this could, of course, foster parliamentary debate, media scrutiny, and trust among the development partners. And in that way, I think the data access is not the only issue. So it's both sides. So you need the management, you need the access, and all of these together can create that kind of harmonized frameworks. And also one aspect where we're coming is these secure data labs, which we have now in South Africa, Uganda, and Zambia. And we have seen in these countries that these have been improved efficiency or discussion on the efficiency of the policies by go in those public debates. Some researchers are coming there, evaluating these, having new findings. Are they meeting the objectives? Then it creates more discussion around the effectiveness of the TE policies. And the last point is maybe just to say that we need all this together. Without these, we cannot know what we are working with. And without these, we cannot make really evidence-based design and decisions in the policies. So I would recommend each country to start working on this. This is the future. But the first steps, of course, are needed to be taken just to digitalize data, harmonize it, document it well, and then it's more usable. Thanks a lot.
Yes, thank you very much, and very, very valid points that I hope everyone can take with them after this webinar. So, investment promotion was mentioned earlier as well, and several tax expenditures are used with this purpose. Miguel, you wrote a chapter about how to administer investment tax incentives in particular. How can good tax administration contribute to improving the effectiveness of these tax incentives?
Thank you, Sophia. First of all, let me thank you for including the administrative dimension of tax incentives, of tax expenditures more broadly in this year's report. This is actually something that the members of the Platform for Collaboration on Tax, the World Bank, the IMF, the OECD, and the UN did earlier this year when we updated the tax incentive principles document. So thank you so much for including this angle of the tax expenditure problem. Regarding your question, I would say that in first place, tax administrations contribute to the effectiveness of tax incentives, tax expenditures, by implementing correctly the desired policy outcomes, whatever it is, for legitimate beneficiaries, right? For those that the incentives intend to target. In this regard, I would say that the fundamentals of tax administrations should be in place as the administration of tax incentives, tax expenditures, cannot function independently of the overall tax administrations. By fundamentals, I mean robust tax functions, minimum digitalization levels, sound governance frameworks, access to third-party data, and so on, right? But the effectiveness, I would say that is also improved when all public stakeholders that are involved in the administration of tax incentives, tax expenditures, I mean, not only the tax authorities, also the customs authorities, or line ministries, or investment promotion agencies, and of course, the Ministry of Finance, all work together under a whole of government approach to prevent abuses, right? Abuses that arise at any stage of the tax incentive, tax expenditure life cycle, right? When they are granted, during their application, and upon their conclusion, right? So we believe, for instance, that all these public stakeholders needs to have an end-to-end view of all beneficiaries of tax expenditures, tax incentives, for which they need to develop kind of an integrated, holistic compliance program, a program that should target the most revenue-critical compliance risks, concentrating efforts on beneficiaries that are most likely to show non-compliant behaviors, and in this sense, alleviating the burden of those with good compliance history. This is pretty much the essence of modern risk-based administration of tax expenditures, tax incentives. And the key thing is that tax authorities need to apply the most cost-effective strategy to different risk populations. Not all beneficiaries of tax incentives, tax expenditures pose the same level of risks. So one-size-fits-all compliance approach are rarely appropriate. In the chapter, I outline a framework based on our work, advising countries on this matter, are taking advantage of some risk tools that we have developed over time. But In practice, however, many aspects of the administration of tax expenditures, tax incentives, I would say it's overlooked, particularly in developing countries. Public stakeholders tend to work in isolation. They follow their own mandates, preventing them to adopt a more integrated approach when administering the tax expenditure, the tax incentives. So, tax administrations in particular, in my experience, in developing countries, perceive that dedicating resources, staff, resources for the administration of tax expenditures, tax incentives, takes up much of their resources without immediate or sizable revenue results. And in my view, that's a bit short-sighted, because a well-designed compliance program, what it does is to safeguard revenue bases and prevent leakages. So I would say that while the governments gain political traction to streamline tax incentives, tax expenditures, all public stakeholders involved in the administration of tax incentives needs to administer them effectively to reinforce the overall compliance with the tax systems and protect fiscal sustainability.
Yes, couldn't agree more. Thank you so much. We actually have a question in the Q&A box. I will read it out loud and then we'll see who is up for grab. So we have the question from James Muturu, and he says, an observation I made over time is countries' difficulties in determining the difference between tax expenditure items from items related to the benchmark tax system. Another challenge that follows is accurate data capture of all tax expenditure items, disintegrated enough to enable higher quality analysis of the economic impact of tax expenditure policies. Maybe Florim, if you will give it a first go, and then we'll see if the other panelists can contribute as well.
Sure. Actually, I can give an experience of GTED use on this. We've been in touch with some governments that when they were unsure about whether to treat a certain provision as part of the benchmark or treat it as a tax expenditure, they went into the GTED and searched for similar provisions. And if they found that, it means it is a tax expenditure in other places. So they kind of followed suit. So at least in that sense, the GTED can be helpful in both streamlining definitions across countries, but also just getting a bit more information about what others are doing and how others see certain provisions. Obviously, it's always very country specific about how the benchmark is defined, but I just wanted to share that. And on the, sorry, let me just open the text of the question again. And on the disaggregation, we've also seen in the GTED that some countries do a better job than others. We, in some cases, there are reports of just total VAT tax expenditure, and as James rightfully says, that's not very informative, especially for evaluation purposes. But not just that, it also may send a very negative picture of tax expenditures to the public, because then all of the focus is on the cost, right? So if you say this is how much the VAT tax expenditure costs, without saying what it is trying to do, even though earlier I said that it doesn't mean that it's doing that, but it still would be probably a good sign to try and give a little bit more detailed information to the public to show what the government is trying to do with its revenue for God. So I think for now, those are my comments related to this. But if anyone else wants to say anything, go ahead.
Yes, Maria or Miguel, do you have anything to add?
Maybe on that regard, that there is a discussion about inaccurate data capture of tax expenditure items. I think that's a challenge, as said in the question, because of course, in many times when you have, for example, tax administrated data, it captures those who pay taxes. So if you give them a tax holiday for 10 years, they are not maybe filing anything to tax authority. So basically, there is also issue in that kind of data quality on tax expenditures, that it's not captured always in these data sources, even you have access to them. So it's in many ways, as Miguel said, that there is these new units in the tax administration on capturing the tax expenditure and who use them in many countries, that they are trying to keep on track on that part. And of course, the data integration between that unit and the Ministry of Finance is very crucial. That everyone knows who get these holidays and how much they have impact on the revenues.
Yes. So since I don't see any questions in the chat and I don't see any hands up,
I think Miguel has unmuted himself.
oh,
Perhaps he wants to add something. Sorry.
No. I don't have comments, to be honest, Christian, but thank you.
Yeah, but Miguel, then I have a question for you. So, what are the most important compliance risks associated with tax incentives?
Oh, wow,
I can guess that there are many.
the list is long. We presented some of the most critical compliance risks in the chapter, right? As I said before, compliance risks arise at any stage of the tax incentive life cycle, when they are granted, during their application, and upon their conclusion, right? During the enrollment process, for instance, I would say that some firms manipulate the nature of their economic activity, or disguise their incorporation location just to benefit from activity-specific or location-specific tax incentives, right? Or when tax incentives are granted on a project-by-project basis, firms may manipulate the information, the projections, in order to show net present value of the investment project, in order to show the need of tax incentives for making the project viable, right? During the application of tax incentives, I would say there are more challenge for tax authorities. Uh, Firms may inflate eligible expenditures to claim augmented tax credits or tax deductions, or some firms disguise ineligible income as eligible. This happens, for instance, when firms conduct mixed operations, right, where some operate under an incentive and others do not. Uh, all of you are familiar with the risks with profit-based tax incentives. They create opportunities for profit shifting through abusive transfer pricing schemes. In the case of free zones, for instance, compliance risks arise when products imported by firms in these zones enter the domestic market without paying VAT, or when these products are diverted to ineligible end users, um, and so on. I mean, the list of examples is long. Sorry, but I will stop here in the interest of time.
Great, thank you. Lucas, do you want to come in with a question?
Yeah, thank you. I just had like a question on like, because I sense that there is kind of like a conflict between making a tax reporting accessible for businesses and getting the appropriate data from tax administrations. Meaning that, for instance, like a country I mean, it could have like a different entry in the tax return for each tax expenditure, and that might collect more data, but then like the tax return is completely inaccessible. So like, what are kind of like the best examples of a tax reporting that is at the same time accessible to the taxpayer, but that makes the tax administration equipped with sufficient data to assess tax expenditures? Thank you.
Thank you,
Thank you,
Lucas.
Lucas. Very good point. We generally advise that filing and reporting obligations uh, shouldn't be waived for beneficiaries of tax expenditures of tax incentive. They should always report by electronic means, in principle. That's why minimum digitalization levels are relevant when dealing with tax administration. Um, I would say that some additional information returns could be useful, for instance, to monitor the the use of the tax incentives over time along the investment and along the life of the investment project uh, to perhaps conduct future cost-benefit analysis, right? So yes, reporting obligations in general shouldn't be waived. That's what we advise to countries. In practice, however, we see that um, free zones, for instance, firms in free zones, they don't generally submit returns or submit information to the administrator of the zone, but not to the tax authority. That's an issue that we discuss plenty with authorities. Thank you.
Yes, exactly. And maybe also worth mentioning is that you in your chat have a box about special economic zones as well for anyone who's interested. Maria, maybe you have something to add to Luca's question, or if not, I also have one, and that is if you have any recommendations to governments concerning data management with regards to tax expenditures. Maybe if you can combine your answers.
Yes. So I don't have much to add. I think Miguel answered that question very nicely. And that's the reality what we see when we work as a researcher in the tax administrative data. We see that not all who should report doesn't report they like tax returns. And in that regard, on the data management side, what would be the recommends to the governments in this field is that I think these are like general recommendation mainly for the data management of the any type of tax related matters. So the first thing is of course to document the process, how you manage these data sets, how you make it yearly comparable, for example, and how to make sure that the documentation is data management is sustainable and basically there is invest in the capacity development as well included in. And in that way, the second recommendation would be to harmonize the data collection. So you always give the same advice how to do that, and especially make the core activity like a core data collection similarly by year to enable yearly comparisons and linking the different data sets together. That's the one element which you should start with. And the final step is to maybe think about more like institutionalizing it. For example, establishing these secure data access facilities to ensure all these data management activities, that they will be more systematic because the lab will move them more systematic in general, and also create this kind of transparent way to evaluate it and make the access to data. So maybe those three: document, harmonize, and establish some systematic structures on the data access.
Yes, great. Thank you. Florim, I believe you also had something to add to Luca's question.
Yeah, but I would really be also curious to hear what Miguel thinks on this. So we've been asked this question by governments themselves when they are looking at their tax return form. So really, the tax return, the main purpose of it is to get the information, how much taxes they need to pay and so on, right? To administer taxes. But it is also the biggest source of data for tax expenditure estimation. So how to balance this? I guess this was also what Lucas was trying to do. How do you balance these two competing kind of objectives? What I thought in the past was maybe you can do that by making the additional from keeping the standard form a bit more lean, but making the additional information requirements only to those who are benefiting from different incentives. As long as I guess it's not too much additional information, so they're not discouraged from benefiting from these incentives. I don't know, but that has been one of the ideas that I was contemplating about.
Yes, Miguel, do you want to respond to Florim's question as well?
No. We fully agree on what colleagues just uh, said about the need of receive information from the beneficiaries of tax incentives. We have seen some authorities creating specific returns for beneficiaries of tax incentives, not only including tax and customs related information, but also asking about job creation, uh, about investment targets, about metrics that perhaps in the future can be useful for conducted cost-benefit analysis. It's not a trend. I mean, it's perhaps ad hoc efforts from certain authorities in different parts of the world. I don't know, perhaps in the future we can convert this in a standard practice.
Yes. So I see that we also have a question in the chat from Deepak Sharma. And that is, are tax expenditures used interchangeably with tax incentives and/or subsidies? In my area of work, there is general acceptance by government to tax incentives, but less acceptance to acknowledge tax expenditure as subsidies. What have been your experience? Florim, since you're here representing the Tax Expenditure Data Lab, we will also distinguish between the different types of tax expenditures. Maybe you want to reply to this.
Yeah, I'll try. So we use the term tax expenditure a bit more broadly to include tax incentives, right? Tax incentives are just a type of tax expenditure, but for example, when we talk about tax incentives, normally what we mean is those that are like investment incentives and things like that. But there are other types of tax expenditures that have nothing to do with investment and don't also necessarily have anything to do with incentivizing behavior. Perhaps many welfare-related policies would fall into that category, or VAT cuts for basic goods and things like that, if countries have those. When we go to the term subsidy, subsidy can also be a direct cash transfer, right? So that definitely not the equivalent, but subsidy would be probably more related to the term tax incentive, again, because they're, I would guess, often more business related. But just to give you a fun fact, like if you think it's fun, the German report is a report on subsidies. And then they provide information both on direct subsidies and subsidy type tax incentives. They don't have all of their tax expenditures there, but the focus is on subsidies. I don't know if that answers the question.
Yes, thank you very much. Miguel, since you focus on tax incentives, do you have anything to add?
No. I agree with Florin. For me, subsidies are direct spending, right? While tax expenditures in general are spending delivered through the tax system, so somehow different. And agree with the distinction he made about tax incentives. We also focus on investment tax incentives. That's what we call it here at the fund. And pretty much those that trying to reduce the tax burden of specific firms or projects or investment projects, basically through corporate income taxes, the value-added tax, and import-related tax and duties. But I agree with his clarification.
Could I add one comment on Florim's excellent presentation of the GTED, Sophia?
Yes, of
You
course.
said that there's a certain continuity over time with regard to the overall amount of revenue forgone reported. It's hovers around between 3.7 and 4% of GDP and roughly 23 to 25% of revenue. But at the same time, we also observe a fundamental shift in tax expenditure reporting, in the sense that the relation between tax expenditures granted on direct taxes, on income taxes in particular, versus those that are granted on consumption taxes, there's a huge change actually. When our observation period starts in 1990 with very few, mostly high-income countries reporting. Today, as we have seen, we have, I think in 2022, we have the largest number of countries reporting in one single year so far. It's above 100. It's, I think, 102 or so. And what we see is that starting, or I would say that in the mid-2000s, numbers are really rising, and more low and middle income countries are reporting. And this leads to a shift in reporting from corporate income tax to from direct taxes to indirect taxes. So the composition of taxes that are reported, or tax expenditures that are reported, revenue forgone, in the GTED has changed a lot. And by now, consumption taxes, indirect taxes are the most relevant portion of tax expenditures reported in the GTED. And this not only has something to do with more low and middle income countries reporting, but also obviously with the general trend to lower corporate income tax rates, which at the same time means that if you grant tax expenditures on corporate income tax and you have lower rates, you spend less in terms of tax expenditures on those taxes. So these two factors combine to produce this picture.
Yes, thank you, Christian, for that intervention. Maybe, Flurm, you can continue by just briefly describing some overarching patterns that the GTED data has really revealed, either with regards to design beneficiaries or fiscal risks.
Yeah, so that was a good leeway, I guess, into this. What I wanted to say, and I kind of saved this, what I thought was one of the more interesting parts of the chapter for last. So please read chapter 2, all of it, but also chapter 2. So we found that two facts or two statistics that are kind of giving us the opposing conclusions in a way, which I found this quite interesting. So the first one is that revenue forgone is highly concentrated among a small number of very large provisions. And around the world, the top 10 provisions account for about 73% of the total revenue forgone on average. And this is like really across different regions and income groups. So it's really quite concentrated, even though the average number of provisions is 150 or so around the world. So, but often just the 10 largest account for about 75%, let's say. But then we also found another fact that if we look at the provisions that provide the number of beneficiaries, which I have to admit many do not, but if we look at those that do, we found that 20% of those provisions have beneficiaries that are 10 or less. So there's a quite substantial number of incentives that benefit very, very few taxpayers. Obviously, yeah, this if you look at the first fact, maybe you will think, going back to my evaluation point, let's evaluate the largest ones because they cost the most. And that's perfectly valid. But then if you remember the second fact, maybe you should evaluate the smallest ones, because if they benefit very few firms or individuals, that can be definitely room for it's adding complexity, perhaps unnecessarily, but there can perhaps also be room for corruption and stuff like that. So I really found this part quite interesting, the imbalance between these two.
Yes, thank you very much, Flurm. I saw that we had one question in the chat, and I would ask Lucas to reply, but I see that you already did that. Thank you. I also see that we had a question in the Q&A chat. I think, Christian, you addressed it, but I'll read it out loud either way. so we can round up this panel. We have the question from Olav Lundstøl. Hi, a bit late into this session. A few queries. One, how are you able to distinguish between the different levels where incentives could exist, ranging from treaties, laws, special economic zones, free trade zones, administrative orders, agreement contracts, etc. Often it can be problematic figuring out which one overrules the other, and this might be disputed. The second question is, are you able to capture equally foreign and domestic? And three, have tax expenditures gone up or down in the data you look at, diverging trends between tax types and categories of countries? Thank you. So I would suggest that we start in the inverse order that we began this panel. So I will give you the floor for a very short intervention, Miguel, and then move on to Maria and then finish with Fleur.
Thank you, Sophia. Again, I want to thank Agustin, Christian, for the opportunity to discuss the administrative dimension of tax incentives, expenditures in this year's report. I think the discussion is very much focused on the effectiveness of tax incentives to promote economic growth, to attract investment, either domestic or foreign investment. But as I pointed out in the chapter, there are a number of compliance risks in connection with tax incentives in particular. So what we try in the chapter what summarize kind of our standard advice to countries. Of course, there is need for a whole of government approach, as I said in my initial intervention. But it's a step on step, step by step. So thank you so much for the opportunity and congratulations for the new version of the database.
Yes,
Okay.
Maria, over to you.
Yes.
Thanks.
Yes. Thanks from our part also to join on this panel and writing the part chapter 7, must say, about the data and its challenges. So I want to just highlight the point that we are talking about in that chapter a lot about challenges and issues related to data and access and management, but I think it gives also some kind of guidelines what you could do, what you can start doing on getting the data quality better, getting data access easier, and how to improve this transparency in general. So I don't have anything comments on the questions, what was in the chat. That was maybe more from Flurim. So I end here. So thanks everyone for having me here and our chapter in the report.
Thank you so much, Maria. Florim, do you have a half a minute's intervention?
Okay, I'll try to make it quick because we don't want Olaf to leave hanging. So just on that point, the main point that I want to make is that we report the data as it was reported by the government. And typically, that's why we try to advise governments to report on provision level information, because that's how you can be able to distinguish between a few of those things. So if this is let's say a reduced corporate tax rate for special economic zones from the special economic zones promotion law or whatever, that should be reported separately. And that would be one way to distinguish between the two. And then on the second question, I'm not quite sure what that is, but we can take this up later in the chat. And on the third question, again, I would invite you to read chapter 2 because it pretty much answers that question in a lot of detail. Thank you all.
Yes, and huge thank you, Florim, Maria, and Miguel, for participating in this panel. And thank you all attendees who asked questions. I think this was a very fruitful discussion, and I also think it really teased us all to actually read the flagship report when we close this webinar. So huge thank you, and over to you, Chris, for the second panel.
Thank you so much, Sophia. Yes, you're right. It is always time is short to discuss all these important issues that are being raised. Now, in this second panel, what we want to do is we want to focus more specifically into some sector and tax-specific approaches. And we have 4 interventions representing 4 chapters of the flagship report here. The first is Agustin Redonda, who is an author together with others of the chapter that deals with evidence on tax expenditures effectiveness. Then Alistair Thomas from the World Bank is joining us, who has been doing research for some years now on VAT-related tax expenditures and targeting. Luisa Dressler from OECD is with us, and she has produced a super interesting chapter on climate-related tax incentives and what we can learn from them or from this aspect. And finally, Sophia Wickel and Daniela Steinbrenner from the Leibniz Center for European Economic Research are joining us, and they will present some thoughts on R&D, research and development related tax incentives. But let's start with Agustin. In your chapter, Agustin, you have gathered information on evaluations of more than, I think, 750 different TE tax expenditure provisions. And the question obviously has to be, what are the main messages? Are there any main messages that can be taken out of this? Can you say something about what works and what doesn't out of these 750 evaluations?
Yeah, thanks, Chris, and thank you all for being here. So yeah, let me back up 2 minutes and give you a bit of an overview of how we ended up with this large database of evaluations. So this is part of a project that we have been working on over the last few years together with UNDP in the context of their UNDP Tax for SDGs initiative. So we basically developed a toolkit that we call Toolkit on Tax Expenditures and SDGs, and it basically seeks to answer 3 questions or give governments 3 pieces of information. The first one is whether the tax expenditures in a specific country are aligned or misaligned with the SDGs, a sort of tagging exercise. And there are green tagging, gender tagging in budget that is used. This is similar, but with respect to tax expenditure provisions and the SDGs. And then the other 2 questions try to shed some light in terms of the potential effectiveness of tax expenditures in a specific country with respect to their stated policy goals. And here the key word is potential. So let me be clear on this. We don't claim that we are conducting proper evaluations for every single tax expenditure we are looking into, but we rather use the existing evidence, so evidence evaluations that have been conducted and published elsewhere, to provide a sort of low-hanging or low-cost piece of information on potential effectiveness for these countries that we are working with. And the third question is a similar one, but regarding externalities. So again, we use existing evidence on tax expenditures to try to identify potential externalities that a specific tax expenditure could trigger. And here we cluster externalities in 2 groups: social, so those related to inequality, poverty, for instance, and environmental related tax expenditures. So, and here's where the database that you mentioned, Chris, kicks in. So to do this, we basically gathered indeed a lot of evaluations. So we have more than 200 publications, including indeed more than 750 tax expenditure provisions that have been evaluated. And what we do is we built up what we call a knowledge database. We classify all this information, and using some basic but useful, I would say, AI tools, we link the provision that the government is interested in evaluating, in assessing, with similar provisions that have been evaluated elsewhere through our database. So that's basically it about the toolkit and how we ended up with this database, with this wealth of information. Just to finish with this, the toolkit has been piloted in 4 countries together with UNDP. It is still work in progress, so that's why the database is unfortunately not available now, but we hope it will be further down the road. So, but in any case, for this chapter and for the flagship report, we said, okay, we are sitting on this wealth of information on tax expenditure evaluations. As you said, let's try to, try to find some main takeaways or messages, key messages that we can infer from these evaluations. So let me quickly go into this first on the state of the art in terms of tax expenditure evaluation. As has been said, the number is rare in most of the countries worldwide, but there is, and we sort of confirm this, a bias because most of the evaluations are actually being carried out and published in Europe and North America. So there's a big bias in terms of where these evaluations are coming from. The largest share of evaluations focus on corporate income tax related tax expenditures or personal income tax related tax expenditure provisions. So this is linked to what I mentioned before. We know that high income countries in Europe and North America tend to use more, to rely more on income taxes, and they use more tax expenditures implemented through income taxation. And this is also reflected in the number of evaluations focusing on these provisions. In terms of the types of tax expenditures that these evaluations focus on, there's a lot on exemptions, but also tax credits, deductions, and up to a certain degree on reduced rates as well. At the high level on effectiveness, what we observe is that indeed there is an issue in terms of the effectiveness or the lack of effectiveness of tax expenditures that have been evaluated. The largest group, 470 more or less, have been found to be either moderate in terms of the outcome, the effectiveness, moderate effectiveness, or weak or very weak actually. And that accounts for 60% or even more of total provisions evaluated. There are tax expenditures that show a strong positive effect in terms of effectiveness, 193, and very strong, only 3. So you can see there is a bit of an imbalance in terms of the overall outcome. The same for externalities. Most of the evaluations do not provide any information. They don't even mention externalities, nor environmental or social ones. But what we observe is that when they do discuss externalities, they tend to highlight positive effects in this respect. But then we wanted to, put some structure into this analysis. It's a bit difficult because evaluations are very heterogeneous among themselves. Different policy objectives, type of provisions, data, evaluation context. So what we did in the end to put some structure into the analysis is to group these tax expenditure evaluations according to the policy objectives of the provisions they are evaluating. And among the 30 policy objectives, with at least 5 evaluations in our database, only 10 show more positive results than negative results. So of these 10 policy objectives that we clustered, there are only 10 that, and I will give you the top 5. This is climate change, tax expenditures to promote charitable activities, to promote or protect SMEs, to develop the agricultural sector, and to promote renewable energy. So these policy objectives kind of gather those evaluations that are showing more positive than negative results, if you want. What do these evaluations have in common? Again, it's difficult to trigger very conclusive, results in this respect. This is very different across each other, but we do find some patterns, general patterns. Usually, these evaluations that have been positively evaluated tend to be tightly aligned with well-defined policy objectives. This is important, not very high-level policy objectives like supporting the economy. These are usually evaluating clearly defined policy objectives. They seek to induce clear behavioral change, so tax incentives are a big part of these positive evaluated tax expenditures. They're often paired with complementary measures that enhance effectiveness and contain costs. The idea of policy packages, we do observe that tax expenditures that tend to be positively evaluated are usually part of these policy packages, which is an important finding. So a few more insights from these. Environmental tax incentives are not only overrepresented in these positively evaluated expenditures, but also a lot of countries are conducting these type of evaluations. We find 11 countries that highlight consistently effective approaches in this type of tax incentives for the environment, which is quite high in our database. In terms of the SME sector, what we observe is that the positive evaluations highlight successful programs seeking to reduce both fiscal but also compliance burdens. This is important. and also to encourage formality and entrepreneurship. And let me finalize in 1 minute with what we learned, what we observed from the negatively evaluated provisions. So what do these negatively evaluated provisions have in common? There are many. As I said, more of the 30 policy objectives that we identified, 20 actually, show more negatively evaluated tax expenditure evaluations, than positively evaluated. And the top or the bottom 5, if you want, relate to tax expenditures related to tourism, housing, education, labor conditions, and regional development. So these are policy objectives which show, or where we found evaluations that perform particularly bad in terms of the effectiveness. So again, very diverse in terms of motivation and form, but there are some weaknesses that we can find across all of them. Low additionality, this is a big issue, particularly when you think about tax incentives for investment. Weak targeting and incidence. So we have a chapter on targeting in VAT, but the issue about targeting of tax expenditures goes way beyond VAT. And insufficient scale relative to the market structure or constraints they aim to influence. So linked a bit to what Florin mentioned about tiny tax expenditures, only targeting a few taxpayers, we see a bit of this. So I will stop here. This is a first grasp of what we can learn and the main insights from the database, but I'm sure we can do more, and we plan to keep expanding that database, so keep the analysis going. I will stop there.
Thank you. Thank you, Agus. And as you said, your focus has been on direct tax-related tax expenditures, but Alistair, you have been doing research in the World Bank on VAT-related tax expenditures, and the findings that you report and that you also put in the chapter in the flagship report are rather sobering, I would say. So why is it that so many VAT-related tax expenditures are so purely targeted?
Thanks, Chris, and thanks for the question. Thanks for the invitation as well to the event, to the project. Perhaps I should first mention, this chapter it's purely focused on targeting. So, but it draws heavily on some previous work that we've done that's looking more broadly at the broader pros and cons of reduced rates, zero rates, exemptions in the VAT that look at some of the broader aspects, efficiency aspects, administrative aspects as well. But we're focusing purely on the targeting here. I guess, to answer your question, I guess the key issue is that we need to distinguish tax expenditures introduced to achieve a particular policy rationale from tax expenditures introduced for pragmatic purposes. So when we start looking at, say, an exemption for financial services, or if you more broadly define an exemption in terms of a registration threshold and removing small businesses, there's cases and arguments in favor of those. But when we look at the reduced rates or exemptions that are looking to achieve either distributional goals or looking to target merit good activities, so internalizing externalities, the literature there's very clear that these are poorly targeted, and it kind of varies the degree of poorly targeted nature as well. So if we start off thinking about achieving distributional goals, there's a bit of a positive news story, I guess, in the fact that, say, if you think of a reduced rate on food, it makes sense in this that poorer households spend a greater proportion of their total budget on food as compared to richer households. So this is going to have a slightly progressive impact in that sense. But who are we trying to target here? We're trying to target poor households, so the bottom 2, 3, 4, 5 deciles. So even though this is progressive, the problem is that you're also receiving that benefit if you're in the 5th, 6th, 7th, 8th, 9th, 10th decile. So that's, again, that's poorly targeted. It's even worse than that if you think of the fact that the higher income groups, they're going to spend more in aggregate terms on those on food and these and other goods introduced for distributional purposes. So in aggregate terms, you're still giving even more benefit to higher income households. We can contrast that with, if you've got good administrative capacity to implement a targeted cash transfer, that's going to be targeted, say, for example, the bottom 3 deciles. Maybe there's a withdrawal, an abatement rate, and so maybe you're capturing some benefit to the bottom 4 or 5 deciles. But then you're still giving no benefit at all to the top 5 deciles. So when you compare that with using the VAT system in terms of targeting, it's really chalk and cheese. But things can get even worse than that. If you look at some reduced rates, say, for example, a lot of cultural goods, reduced rates on hotel accommodation, on restaurants, these types of activities are consumed so much disproportionately by higher income groups that you don't end up just giving more in aggregate terms to those higher income households. You give even more as a proportion of total spending as well. So those can actually be regressive. So I guess in that sense that, you can look at one end of the spectrum, reduced rate on food is poorly targeted, yes, but at least it is contributing to the policy goal a little bit. Whereas some of these other reduced rates they're actually countering some of your distributional goals. If you look at other aspects in terms of trying to target merit goods, the positive externalities, say a reduced rate for books. The problem here with the VAT system is that it's an ad valorem tax. And if you're trying to target externalities, you should really be applying an ad quantum tax. And so that's why, we think of health-related taxes, excise taxes are useful taxes for trying to target negative externalities. This here, we then flip on the positive externality side. The example that I always think is quite nice is if you think of a hardcover book versus a softcover book, the exact same book. One's more expensive than the other. So if we're using the VAT system to properly target that positive externality, should I say, then a child reading that hardcover book must be generating more social benefit than the child reading that exact same softcover book, which I think is a pretty challenging argument to make. Broader than that, say, Louise will probably touch on this, some environmental related concessions, you're automatically excluding, say, business use, for example, because they can claim an input tax back. So you're losing a big chunk of the potential target audience to achieve environmental goals. So more broader aspects like that. But let me stop there for time.
Yeah, thank you, Alistair. Many issues already raised. Luisa, I think in your chapter you focus more again on direct taxes and tax incentives, but obviously climate-related tax expenditures in general there's a huge debate right now about this, and more countries are introducing them in a less and less coordinated way, I would say, perhaps. What do you think? What are the main challenges regarding the design and the targeting posed by climate-related tax incentives?
Yeah, thank you, Christian, and thank you for the invitation to the panel. Very interesting. Indeed, I will talk more about direct taxes, Alistair, no VAT, because so we before speaking about the challenges about climate change related incentives, I want to give some observations from an ongoing project which focuses on corporate income tax incentives related to climate friendly activities and investments, because what we see there, and I think it's important to be at the same page, is that they're really sprawling and the targets and designs are very different. And this is only one instrument, only corporate income tax. I'm not talking about other incentives. And I'm talking about incentives and not expenditures, because this project looks at those that really aim to incentivize climate relevant investments. So we have this project at the OECD where we compare countries, 45 countries, OECD and G20, and how they use these incentives. And what we see is that more and more countries use them, and it's really exponential. Like 50% of the incentives that we observe were implemented after the year 2020. So it's really very recent incentives. We have, of course, some before, but there's a peak, like it's going up. And although they all have the same objective or a similar objective, right? The aim is to encourage some climate-related investment or activity. They vary on all fronts. It's rare that one incentive looks very similar to another. I mean, there are some, but not. It's very rare. And they don't only differ by the instrument choice, like credits, allowances, reduced rates. They also vary a lot on how these specific instruments are designed, meaning whether a credit is refundable or not, whether a reduced rate is temporary or permanent, whether an allowance is accelerated or enhanced. So the rates are different. Very many differences here, and also the targeting is different. So some of these incentives go to entire sectors, so transport sector, industry sector. Others are very specific to to specific technologies, where you see that a country wants to implement heat pumps in industry or specific efficient motors or these kind of things. And then we have some nice broad-based incentives that are nearly technology neutral, where countries try to enhance energy efficiency improvements or carbon CO2 emission reductions compared to a baseline. So which is not targeted to a specific technology or sector. And so, I mean, from the literature on incentives in general, we know that some designs work better in specific circumstances than others, and this is likely reflected here, right? Countries that want to go to a net zero economy, they all start from different starting points, have different economic structure, different circumstances. So that's why probably some of these incentive designs are justified and targeting is justified, because it's just very different countries. But these observations also speak directly to the challenges that we see, and I just want to mention two to not go too far. I mean, the challenges we see here are very similar to the challenges we have with general incentives, right? With few additional considerations, and that's what I want to focus on. I mean, incentives come with risks and costs. We all know that. We don't need to name them all. And the big challenge is know how to get these incentives right, achieve objectives at lowest cost. And here the objective is reduce carbon emissions or get to a net zero economy. And so then the first challenge or the first question the governments need to ask themselves is, of course, you all know that, is do we really need an incentive for this specific policy problem? Or is an alternative instrument a better choice? And I think in the climate policy area, it's very clear that the policy mix is very wide. So tax incentive is just one little item in the climate policy toolkit. We have carbon pricing, we have regulation, we have direct support, we talked about subsidies, and we have tax incentives and many more. So then it's even, it's very important that governments ask themselves, if I want to, I don't know, get a specific technology onto the market, do I need a tax incentive, or is it enough to have a very strong carbon price with some direct support? If I want to achieve energy efficiency improvements and I know the technologies are mature, maybe a regulation is the way to go and not a tax incentive. So I think here it's really, one needs to take the step back and look at the overall policy mix instead of only focusing on the tax incentive design. No, it's first, is the incentive needed? And I think what we see nicely through our work, I mean, we have this database now, but we also have some more analytical papers or context papers where we see is that some countries are actually quite good at articulating nicely where the tax incentive enters the policy mix. So we have some countries, Netherlands, Belgium, where they have explicitly said, okay, we have this strong carbon price, and now we give this tax incentive to these kind of businesses to actually help them get ready to pay this carbon price in the future. So we see some good policy packages and well articulated, aligned policies, but it's not the case everywhere. And so, yeah, streamlining the policy mix and incentives within is very important. And the second challenge, I think, that we observe now that we get this data in and see how countries do is that, so let's assume country has decided it's the right instrument, then the next question is how to design and how to implement. And here again, the general tax incentive literature holds, right? Some designs work well, some do not, and the circumstances, we know them as well. But what is important, and I mentioned it earlier, is that really here in the climate context, countries start from specific circumstances. The needs are different. It's not only different sectors, it's also different actors, different investment types. And there's no single incentive design is equally effective across the many different actors and investment projects. If a country wants to target small versus large, firms, if they want to target a loss-making versus a profitable firm, if they want to target a new entrant versus helping an incumbent to switch, the incentive design is different. If we have a lot of loss, like an innovative entrant with a brand new technology, we'll need a different incentive design than an incumbent that is a dirty producer, and that we need to convince actually that all these profitable assets can be written off, and there's a reason to invest in a new one. So I think what is important and what we see is that governments need to consider their firm and project landscape when designing the incentives. I mean, I said at the beginning that the incentive designs vary. How well they align with the country's economic profile and the objective they have in their net zero emission plans, we don't look at that. We just see the varying designs. And so I think we try to talk more about this. And yeah, so the challenges, I would say, the challenges of designing incentives right do not go away in the climate context. It's the same as we have in the general tax incentives discussion. But yeah, I think it is important to. There's so much money that goes into it. It's important that we really help to get the designs right and the targeting right, so we put that money into the right directions and not lose it on the way.
Yeah, thank you, Luisa. And I think many of the issues that you raised speak also to Daniela and Sophia's chapter in the flagship report, co-authored by you together with others, on R&D related tax incentives, because the issue of technological innovation obviously also is highly relevant with regard to climate related tax incentives, and in a broader term also for you. So when you listen to this, and Luisa's key message was there is such a huge heterogeneity of context conditions and of different situations and actor constellations and so on, that it's very difficult to think of general types of tax expenditures that can serve as a blueprint to everybody. So for you, Daniela and Sophia, what would you say? How should R&D related tax incentives be designed to be effective? Can you say from your research, can you identify specific patterns or things that should be taken into account?
Thanks for inviting us to write the chapter on R&D tax incentives, which was mostly based on empirical evidence or literature analysis of R&D tax incentives, as they are quite common, well developed. They are often under empirical scrutiny or analyzed for a lot of countries. However, as Augustine already also said, the empirical evidence is quite well available for EU countries, for the US, not so much for developing countries, and we more focus on the EU context. Maybe this also then gives an indication maybe on the best practice, because the European countries still, they are a bit diverse, but they are more developed, so a bit more equal for comparisons and also then to develop best practices. And maybe, as we know from the general tax incentive literature, it's always that if you evaluate the effectiveness, I think the literature comes up with some several criteria. So at least in the R&D literature, that you should have a broad eligibility, so that you should be targeted in scope, you should provide a timely liquidity effect. The R&D tax incentive should be easy to understand and to integrate in the investment decision processes planning. And furthermore, they should provide a streamlined administration procedure, which is not that common in some countries. So, but why? And it looks really easy to say these kind of aspects, but when we looked at the 43 R&D input-based tax incentives, and on top the output-based IP boxes, which are heavily used in European countries, there's a lot of differences observed in the design mechanisms. And some of these differences are also empirically analyzed. And we would say if if the design is non-selective with respect to the eligibility group, it's not so prone to misjudgment, this kind of incentive, because for government, especially in R&D tax incentive, they should be open to technology. So it's upfront often not really clear which kind of technology or which sector provides the most spillover effects. So that's why the literature argues more to be non-selective in this respect, and also this holds true for the text-based definition. So we would argue you should be open to R&D wages, allowances, overhead costs, but also for subcontracting if you want to include or did not harm the smaller countries which heavily rely on subcontracting because they do not have the R&D personnel, or at least they can't build it up that fast, so that these kind of companies should not be taken out if you want to incentivize them for more R&D. One of the main drivers the literature, I think, argues is liquidity impact. If you really want upfront support in a financial aspect, you should provide a fast liquidity impact. So, and this is as fast as possible. It's mostly if it's in the payroll taxes or if you can credit it against their social security contributions, because then you are also independent often during economic crisis, because you have to pay payroll taxes in these kind of cases, even if you're in a loss position in the profit taxes, which then gives you also the security and that you can plan with these kind of funds, even if you invest in R&D investment during these kind of situations. And especially during these kind of situations, you need this predictability, because otherwise you hold back with your investment, which may even worsen the situation overall. Luisa already mentioned, I think, also tax credits. Yes, so tax credits, I think they are heavily used in R&D tax incentives literature because they are quite salient, transferable, and they are often easily accessible for companies and also to integrate in their investment planning processes, because you can have directly number to your kind of investment, which you can also use in the planning. With accelerated depreciation, it's always a bit harder to grasp the financial amount. So this is why tax credits are quite salient feature for also investment planning for larger companies. And in particular, if it's a volume-based incentive, because then you're not dependent on the past investment procedures. One feature which I think is sometimes underestimated, it's the permanent feature of a tax incentive. Yes, there are risks if you have it as a permanent feature, because if it's not well designed, you can incur high costs. So if you have a permanent feature, you should also do a regular evaluation, monitoring, and adjustments. But there are a lot of countries who go on these yearly extensions of R&D tax incentives, and R&D tax incentives or R&D investment is a long time investment. So if you do not know really what happens to my incentive in the next 2 years, I may really do not use these kind of incentives, because it's also costly to get to know the regulation if it changes regularly. And this directly links to the last point. So these kind of incentives needs to be easy to administer and monitor. So we need digital one-stop mechanisms. So they should be not too many ministries or institutions involved if you want to use these kind of incentives, because this again hampers especially smaller companies and startups which do not have the personal capacity to get all the information. So I think these were the things which we had a look on, and we need to agree, or we found out that even if the European member states have a lot of experience with R&D tax incentives, there is not even one incentive which would fulfill all of these criteria, even if they sound very easy. So as Luisa said, it depends also on the economic situation and what you really want to achieve. But yeah, so there's high diversity, and even if it sounds sometimes quite easy to design these kind of incentives, there's a lot of heterogeneity.
Thank you, Daniela. And just to follow up on this, one additional layer of complexity obviously is the transporter or the international dimension. And in your chapter, you discuss how R&D incentive regimes can be influenced, or actually are already influenced by international tax rulings and regulations, and in particular the OECD BEPS initiative with the famous Pillar 2 of the GLOBE project that introduces a global minimum tax for large companies, large multinational companies, and this has been discussed not only by the OECD but also by others with regard to the implications such a global minimum tax has on the application also of tax expenditures or tax incentives more particularly, and in particular the difference between cost versus profit-based tax incentives plays a huge role there. So the question that goes to Sophia in this case, how are R&D incentive regimes in particular affected by the Pillar 2 and by the implementation of the global minimum tax?
Yeah, thank you very much, Christian, also for the invitation. And you already mentioned briefly what Pillar 2 is about, but maybe to remind everyone briefly, Pillar 2 is an international agreement of more than 130 countries, and it aims to ensure that large companies, so companies with a turnover above 750 million euro, pay a minimum effective tax rate of 15% on their profits. And if a company falls below this level, a so-called top-up tax is levied. And this top-up tax could reduce or even completely reverse the investment incentives that are provided by tax reliefs, because usually tax incentives reduce the effective tax rate, and then the top-up tax increases the effective tax level then. However, importantly, not all incentives are affected in the same way due to this design of this global minimum tax. I won't go into details, but overall, input-based incentives are less affected and therefore are favored under Pillar 2. So, for example, governments may grant accelerated depreciation for tangible assets because this regulation is unaffected by the global minimum tax. Also, the so-called qualified refundable tax credits are less impacted by Pillar 2. And this means that governments may increasingly consider to implement such refundable tax credits in their policy mix, and because they also fulfill most of the aforementioned best practice criteria. So, for example, they are salient, they are transparent, and also offer immediate or rather timely liquidity. And also, instead of relying on many parallel incentives, we argue that governments should aim to implement one single unified R&D tax incentive scheme that is accessible to all types of eligible taxpayers. And this would be, for example, fulfilled by a qualified refundable tax credit. Overall, we also would say that a balanced approach that considers all the aforementioned best practices offers the greatest potential to foster innovation also under Pillar 2.
Thank you so much, Sophia. We already have questions also raised in the Q&A section here, and one of them refers to climate-related tax expenditures. I have a question on estimating the environmental and climate impacts of tax expenditures. Which countries would the panelists highlight as having implemented best practice approaches to estimating the effectiveness of environmental and climate-related tax expenditures? What did these countries do? Do the panelists have any specific recommendations for low and middle income countries? Hugely important question, I would say, and perhaps I would first give the floor to Agustin, since Agustin, Sophia, and I have just finished a study commissioned by the United Nations Economic Commission, Latin America and the Caribbean on climate-related tax expenditures. And I guess that Luisa will also like to chime in afterwards. But Agustin, you go first, please.
Yeah, thanks, Jacqueline, for the question. Yeah, indeed. In this paper, what we do is we try to use our GTED to first extract data on the use on what we call environmental tax expenditures. And we do find that many countries, besides or moving beyond the lack of transparency and reporting, but based on the data we have in the GTED official data, indeed, many countries, as Luisa said, more and more are actually using these environmental tax expenditures and tax incentives. So there's a bit of data analysis there that I invite you to take a look at. But then in another part of that same report, indeed, we move into the evaluation. So unfortunately, there we do not do a sort of cross-country analysis on the state of the art in terms of evaluation. We focus on a few countries, 5, and which we arbitrarily selected for various reasons. In the case of Ireland, because they have a comprehensive framework of evaluation, and this is linking to other question that was done by Olaf, I think, in the chat. So they nicely link ex-ante assessments, so those assessments that need to be taken in place or implemented before the introduction of a new tax expenditure with ex-post evaluations. And they recently included an ad hoc question trying to assess the environmental impact of tax expenditures. So that's Ireland. Then we also mentioned the case of Indonesia, because Indonesia is one of the best performing countries in tax expenditure reporting. As you can see in our GTETI, they are still ranking number 2 after South Korea. And indeed, in their tax expenditure reports, in the official reports documents, they include more and more evaluations, assessments of tax expenditures in general, but also moving into this discussion about the impact of environmental related tax expenditures. They have at least 2 evaluations in the last reports on, if I recall correctly, electric vehicles, tax incentive for electric vehicles, and also on the supply side on a bunch of tax expenditures that they have in place to sort of switch the energy mix production to renewables. So these are 2 countries. There are a few more in the study, but indeed, I mean, this is, as for any other tax expenditure, I would say the big elephant in the room is that we need more evaluations, and also in the case of green tax incentive or green tax expenditures, this is important because they are in any case being used more and more. So this is an area that we consider it's crucial that governments put more effort in. I'll stop there.
Luisa, do you want to add something?
Maybe just a little remark. I mean, I haven't looked at the tax expenditure reporting like you do, so that's quite complimentary, I think. But if I just go to the empirical literature and think and look for a paper that evaluates uptake of effectiveness of tax incentives in, for example, GTETI incentives and in generating investment, climate-friendly investment, and then emission reductions, there's not much. Like there is just not much empirical analysis, if there is at all. And I mean, one of the, and I think I come back to this policy mix. It's very difficult already to identify a policy effect. And then if you have these overlapping policies to really see whether it's the incentive that made that change, it's very difficult. And I haven't seen a lot. I know that the Netherlands, they do very often evaluations, but I don't recall that as a big empirical analysis. They do a little bit of regressions, but it doesn't, I mean, as we know, it has to go beyond just looking at the take-up of the incentives. We have to go this step further in the causal identification, and I haven't seen much for the moment, unfortunately.
Thank you, Luisa. But let me just say that what I gather from the intervention so far is that one issue that any assessment of tax expenditure has to deal with is the issue of spillovers, positive and negative spillovers, or creation of positive and negative externalities. And I would like to bring Alistair in here again, because this obviously is also something that VAT-related tax expenditures show. And the question would be, what are the main unwanted externalities from VAT-related tax expenditures, and what can governments do to address them?
Thanks. Well, I guess I think I would sort of separate out the impacts of reduced or zero rates from those of exemptions. Obviously the first point, of course, loss of revenue is it's not an externality, but it's the cost we're all worried about. So there's that. But even broader than that, you're trying to achieve one goal. You're distorting consumption decisions, so that's problematic with a reduced rate. But also, just when you move away from a single rate structure to a multi-rate VAT, you're creating vastly greater administrative costs and compliance costs associated with that. There's a massive amount of litigation that goes on trying to distinguish grey areas between different types of a product that is standard rated versus reduced rated and so on. So there's a bunch of additional costs there that you face due to having a multi-rate VAT structure. But I think even just as more problematic, or perhaps even more problematic, is when you think about exemptions and the broader costs that they have, because really an exemption is okay. You're not charging VAT on the sale, but you're not able to claim back the input tax that you've paid, and so that means you embed. So that breaks the VAT chain. That embeds VAT within the sales prices that can then not be claimed back, and that creates all sorts of problems. So the standard problems, the key problem there is you have production distortions then. So that was pretty much the whole rationale for moving away from turnover taxes towards the VAT was to avoid production distortions. So you lose out there already. But then you also have incentives for self-supply and so on. But actually, something that we wanted to look at, and we talk about a bit in the chapter, is following through those indirect effects from the VAT into final sales prices. So if you think you might be targeting. So you're targeting exemption, you're really trying to target final sales. So you've exempted food, or to use the same example as before, or agriculture. You're trying to target final sale, but some of that food is still used as an intermediate input. So when that's used as an intermediate input, again, you have some embedded VAT in the supply chain that gets pushed through, and that goes through the supply chain, cascading through the supply chain, and increasing final prices for consumption of other goods. So you have the direct effect that you're trying to achieve of lowering the price of final consumption of the food, but then you've got a counteracting impact, increasing prices of all other products that use food as an intermediate input. And so some of the analysis we did on that was, well, firstly, it's very non-transparent. But then secondly, what we saw with some countries is that you could actually have the opposite impact, a counteracting impact on overall distribution. So you're trying to create a progressive impact with this exemption of food, but because of the patterns with which you're increasing other prices and this indirect effect, that can actually negate some of that progressivity. So we saw we looked at 27 countries and doing some hypothetical simulations. So 3 of those countries, the progressive patterns moved completely to a proportional pattern. So there you've got this separate indirect effect that's completely counteracting the desired impact that you're having. So I think that's another key aspect that people don't think of when they think of an exemption. People often think of an exemption as if it's a zero rate. And it's really not. It's something completely different. It's against the whole core principle of the VAT. So I guess if I push one little message there, it's that we're not fans of reduced rates, but we're even less fans of exemptions. So countries that sometimes look to many low-income countries do apply an exemption to try and achieve the same result as something that other countries would use a zero rate. It has these broader negative impacts, and they should be really looking to use a zero rate rather than the exemption. Again, better still, look for a better targeted mechanism rather than the zero rate. Again, the VAT system is not a good mechanism for targeting. So, thanks.
Yeah, thank you. Also, thank you for pointing out something that is also a main message across the board here. That is the issue of transparency and how difficult it can sometimes be to be really transparent about the impact and the size and the fiscal cost and so on of the tax expenditures that you use. I would say that we have managed to be on target with regards to time, and if there are no other urgent issues being raised from the audience, I don't see this at this moment, then I would say let's put an end to this second panel. And thanks again to all of you, Alistair, Luisa, Daniela, Sophia, Agustin, for your inputs. I think you made an excellent point inviting the audience to look at your chapters and to look at the flagship reports. Many thanks for that. And with this, I hand over to Agustin to close this event. Agustin, over to you.
Yeah, thank you, Chris, and yeah, thank the panelists. So yeah, I will be brief. I think we all agree in our team that it's great the tax expenditures, but also tax measure policy, broader speaking, keeps gaining momentum across countries. This is always true, but particularly now in times where countries are fiscally constrained and governments around the globe are sort of desperately looking for resources to fund their economic and development strategies. Neglecting the role that tax expenditure reform can have to move in that direction is just not an option. So as Flori mentioned, the latest version of the GTED confirms that the revenue forgone through the use of tax expenditures keeps being significant in many countries, I would say most of the countries worldwide. Lucas and Paula showed that a lot remains to be done to improve tax expenditure reporting practices and to enhance transparency in this area, even among best performing countries, by the way. And it's exactly this combination, I would say, of costly and, up to a certain degree, unscrutinized tax expenditure policies what motivates our work, or most of our work here at the Tax Expenditures Lab. But what we do observe is that the big elephant in the room, as Lisa mentioned, is indeed the lack of tax expenditure evaluations. So obviously, cost-benefit analysis, other types of impact assessments, distributive analysis are the only way for governments to understand if their tax expenditures are value for money, they are cost-effective, they are, making the trick in a sense, or not, right? In other words, we know that these tax expenditure evaluations should help governments to understand if these tax expenditures are cost-effective, or if they are too costly, or maybe redundant, or triggering side effects, externalities, as it was mentioned, and hence need to be revisited or reformed. Without this information, there's no way governments can enhance their tax expenditure regimes based on evidence, and that's a key issue. But even if we all know this, we still observe that the evaluation is probably the main stage within a tax expenditure policy cycle, where most of the governments need to do more and better. So as Lucas mentioned, there are two indicators in our GTETI, indicators 5.4, tax evaluation framework, and 5.5, availability of tax evaluations. And these are the indicators scoring the lowest on average across the 25 indicators. And the one on availability of tax expenditure evaluations, the ones where we capture, the indicator where we capture how many and which types of evaluations are being conducted by governments, is actually one of the two where no country, not even the best performing countries, is scoring the highest possible score. So we really observe that this is a big issue. So this is why we chose indeed the topic of this year's flagship report to be tax expenditure effectiveness, exactly to discuss this type of questions. And I think the panels did the trick. We had a very interesting discussion, but I can tell you, we reviewed all the chapters, so these should be only seen as a teaser of what the co-authors and the presenters today have put together in the chapters that they contributed to the flagship report. So I really invite you to go through the different chapters more in detail. There's a lot of information there and definitely worth a read. So, but with that, I would just to use 30 seconds to thank a lot of people that is involved in this process of today's event, but more broadly in the GTED, in the GTETI initiatives. So Andy Colby, who's our web developer and does a great job with our website platforms. I personally really like them. We get a lot of good feedback on the visuals and functionalities. So I hope you also like those. So thanks a lot, Andy. Our comms teams, both at IDOS and CP, so Pepa, Cornelia, Kati, Tanya, thanks a lot. We have been rushing to have the flagship report done today and up and running. So thanks a lot for all your great support. The international team of consultants or group of consultants that we have doing the nitty-gritty work, both for the GTED and the GTETI. Florin mentioned the GTED ones, and in the last slide of Lucas' presentation, you could see the names of the ones involved in the GTETI. So we really appreciate the work they put into this. So thanks a lot. And last but not least, the core team, Christian, Florin, Sofia, Lucas. It's really a pleasure to work on this on a daily basis. So I really appreciate working on these projects with you. I'm sure we'll keep doing that in the next years. So from my side, that's it. Thanks a lot for having taken the time to be here today. We invite you to check both the GTED, the GTETI websites, the documents, the flagship report. And as always, just stay tuned on the Tax Ventures Lab website, but also our social media channels, because we will keep the work going. So any updates will be published there. Thank you very much. Have a nice day.